Hello, everybody. We are here with the Mastermind for fundraising in VR and Metaverse. We have a few VIP guests. Michael Burtov, the author of the Evergreen startup, which is one of the main Bibles for early stage financing, especially using the latest innovations in fundraising. We have Stephen McDonald from Quest for Business. We have Renji, who has raised 9 million, like over 9 million, the second round being in a matter of 2 days with a very small budget. So we're going to start off with Michael's lecture. Guys, feel free to use the hand raise function or jump in at any point. And I'll pass the screen share over to you, Michael.
Nice. Give me 1 second. Let me get stuff set up. I will try not to, and I'll try not to have it be too boring. So let me just 1 second. Let me just get this set up.
While you're doing that, I think we should call out the fact that Hesse is a swimming pool right now. I'm concerned.
Holding my breath. Happy Friday, everybody.
Sorry, guys.
You have to dive in, obviously.
I was wondering if he was just under there, like swimming. Like I'm swimming in projects over here. Ah!
With my waterproof phone, I can swim and participate in the meeting.
Living in the future, baby. You know how it is.
Yeah. When is Quest going to be waterproof?
Right? When's it going to be sun outdoor proof? That'd be a miracle in itself.
Can you guys see my screen?
Yep.
All right. So I'm going to skip over some parts. This is generally where I introduce myself, but let me give you basically an idea of what I'm about to show you. So we have a relatively abridged amount of time today. This is part of a series of lectures that I give with the MIT Enterprise Forum and a bunch of other universities on alternative fundraising. So this presentation and what I cover is, what I'm an expert in is raising money outside of the traditional VC, private equity, that kind of space, angel investors, although I've raised money in that space too quite a bit. So this is a part of a lecture series. This if I was to go for this whole deck, it would take about 4 hours and everybody would be asleep by the end of it. So I'm gonna be really quick. You'll actually see me jumping around a little bit from here or there. Yeah. Can you guys put yourself on mute unless you have questions, and then but if you do have questions, just feel free to interrupt me. Anytime. There's no special place. Just if you have a question, just ask and we'll dive in. I love questions. Questions are probably the best way to really talk about the topics that people care about, rather than going through this set, deck. So a little bit about me. I'm a serial entrepreneur. I've had several companies that I've rose from idea to millions in revenue, millions in funding, and I've been on TV and stuff. So that's basically me in a nutshell. I'm also an expert in specifically what we're going to be talking today is equity crowdfunding. I've raised a bunch of money for a bunch of different companies, including my own, in the space since 2016. I also work with a couple of VR companies to this day, Zoom being the currently active campaign that you can see on wefunder. I organized that campaign for Eric.
Which is the VR fitness exercise bike concept.
That's right. Yep. We're gonna skip this part. Give me a second. Okay, let me just do a basic overview of the difference between equity crowdfunding and venture capital. So I actually think this is a pretty important thing. So equity crowdfunding as a space is brand new. It's a brand new space. It's only been legal since 2016. It's only been active for about 4 years. It's a brand new space, whereas venture capital, VC, has been around as a model for 70 years at this point. It's quite a bit. These are slightly outdated numbers from 2019. I really need to update this, and they have gone up a lot on the EC side, but as far as 2019, it's about $20 billion, $18 billion in 2019 went through EC, contrasted with 300 billion with VC, with venture capital. So it was about, it was about 10% of the volume. Now it's actually much higher. I really need to update the slide. The other key differentiators between VC and EC is the representation of the founders and the investors. So to get a little bit into the history, and the last time we chatted, I might have gotten into this a little bit, but it's actually really important to notice. With venture capital, with the model of the traditional fundraising model, there's only a certain amount of people in the world that can invest in you. So depending on where your company is located, but let's use the United States for an example. The United States uses a term of art called an accredited investor. An accredited investor is somebody who makes over $250,000 a year for more than 2 consecutive years and has a net worth of over $1 million, excluding the value of their primary property. So for all purposes, in order to invest in private companies before they're public on the stock exchange, you have to be a millionaire in the United States. So this has created a lot of issues in the space because, as you can imagine, about 86% of the millionaires in the United States are older white men. And now I have nothing against older white men, but there's a very specific type of interest area that older white men tend to invest in. So, and there's specific types of founders as well. So younger folks or racially diverse folks or ideas that are not traditional tend to be really, really underrepresented in the VC world. Just because by law, they only allow a very specific demographic of people to invest in early stage companies. Now, this was a real issue in 2008 when we had the global economic crash. They realized that this demographic of people that the US Congress put in charge of investing in startups wasn't investing anymore. And they needed to reform that. And one of the reforms that they had under the Jobs Act, under the Obama administration in the United States, and by the way, similar across the world in other places, similar timing, they introduced what's called equity crowdfunding. Equity crowdfunding, the easiest way to think about it is just letting regular people invest. Okay, so you don't have to be an accredited investor, you don't have to be a millionaire to invest in startups anymore under this model. You can just be a regular Joe Schmo and invest in a privately held company. Now, they're making the company does have to do some disclosures, they have to use a platform, there's other regulatory things to reduce fraud, but that's really the idea behind equity crowdfunding. The name is actually kind of a misnomer. Congress named it that because of the popularity of Kickstarter at the time, because it's called crowdfunding, so they decided to call it crowdfunding, but effectively this is just a reform that allows regular people to invest in a company. So what we've seen in the space over the last 5 years that the space has been particularly active, is that the distribution of equity crowdfunding founders is about, there's 26.7% female, as in the founders of the companies that have gone through successful equity crowdfunding campaigns are about a quarter female, whereas in the venture capital world, this is current numbers by the way, are about 2% female. So 98% of the companies that are funded by venture capitalists are run by men. Distribution of founders who are Black or Latino in the equity crowdfunding world is also about a quarter, and contrasted with the VC world where under 1% of the founders that VC invest in are Black or Latino. So, by the way, these sound like they're like, when I say there's like 97% of the investments that are made by the venture capital industry go into companies that are run by white men, it sounds like I'm talking about the 1950s or the 1940s, but I'm not. I'm talking about 2022. I'm talking about now. These are current numbers. So that's something to keep in mind, especially if you're a minority founder or if you have an alternative idea, because the distribution of the industries that are being funded, as you can see, and I'm not going to read the numbers on the screen, but the distribution of the types of industries that are being funded are also much more narrow in the VC world. Distribution of the investors, as you can imagine, is also very different between the VC and the EC world. So with venture capitalists, about 10% of the venture capitalists, the decision makers, the partners in the funds are female, and about 2% are Black or Latino, which has more diversity than the distribution of the founders they fund, but still very underrepresentative of female and Black or Latino founders. And the distribution of equity crowdfunding investments, investors, about almost a quarter are female, and about 13% are Black or Latino. So you see a lot more participation from what you would call alternative investment profiles. So alternative people who belong in who participate in alternative economies and have alternative demographics. So if for your project that you're working on, your users are more diverse, then equity crowdfunding is a particularly good fit for you. just because your users can be paired into your investors with this particular model, whereas with the venture capital model, you're much more limited to what you can do. Any questions here on before I move on? No? Okay. All right, so one of the important things that, before we really dive into the tactical stuff and other things, and this applies to any kind of product, whether it's a metaverse product or a physical product, this applies in general to the difference between selling your product and selling your security. The security for these purposes are stocks, bonds, options, warrants, things like that. All of these things that we should be very familiar with as startup founders, especially the ones who've raised money. There are the key differences between the two things and the way you market the two things and the way you evaluate the two things are, and I'm gonna go through this one by one, so if this is boring, I'm super sorry. But there are some interesting insights here that I think will power a crowdfunding or a traditional fundraising campaign. One of the biggest differences is that products are generally not available when the company is formed. And I'm not talking about the corporate formation. I'm not talking about when you have a corporate entity. I'm talking about when an idea hatches, when you put your team together, you and a co-founder, or just you by yourself. At the very beginning, your product is not available. You're still developing it. It could be years until it's ready for consumption, to be ready to go to market, to sell to people. Whereas your securities are. So as soon as you have an idea, you can sell a security that represents the future value of your idea. Where you can go to your friends and family and say, I just got this idea for an awesome new application for VR. Why don't you give me $5,000 to help me do whatever? That's already a type of security, and that's available at the very beginning of a company. So you don't need to wait until you develop something in order to sell securities. Products are generally not regulated. So there are definitely products in the defense space, in the biotech space, in the pharma space, things like that, that do have a lot of government regulation attached to them. But for the most part, the products that we make do not have government regulation attached to them. Whereas securities are very heavily regulated. So with a securities product, you sell your stocks, bonds, options, warrants are very, very heavily regulated by the government, no matter where you live in the world. Products are available on the public market, as in you can just go on Facebook and sell a copy of your product to people. You can publicly solicit, which is just a term of art saying you can publicly advertise your products for sale. Securities, you cannot. Securities are private market, as in you have to qualify the purchasers of your securities before you can offer for them to invest in your company. Which is a fundamental difference. It also just really narrows who you can advertise to. Now, these two things have asterisks next to them because slightly different. That could be crowdfunding, although there's still regulations attached to these things. Products have diversified customers, as in you can pivot from one industry to another. If one group of people doesn't want your product, you can go and try to develop a product for another group of people. Investors are very specialized. So investors, you cannot pivot from one group of investors to another for the most part, because if you're the industry that you have as a very tight-knit group of investors, that you will be targeting with your messaging. So you can't really pivot from one investment, like VC investment strategy to another with securities. So that's a particularly big limitation. Products, importantly, don't compete with other startups. So let's say you have a VR game of some sort, and there's a lot of VR games out there. You're not necessarily competing with the other VR games because none of them really have that much market share individually. So you don't really compete with things that don't have a lot of market share. When you're out in the public, you're competing with the old way of doing things, non-VR games or no games or whatever. You're competing with how people do stuff now. You're not really competing with the other game providers in this particular example. Whereas with securities, you are directly competing with other startups. There's only a certain amount of funds or a certain amount of investors that are interested in investing in this space, and they have a very limited amount of money, and they're evaluating all of the startups to choose the one that they would be investing into. So you are directly competing with other startups when you're raising money from investors, but you're not competing with other startups when you're selling your products or services. Products are not sold in rounds. So a round, I'm sure everybody's familiar with the concept of basically, every year or every 2 year going to like an all-you-can-eat funding buffet and stuffing your mouth with as much money as you can, and then you don't eat for a year or two, and then you and then you go back to the buffet in a couple of years. That's the concept of a round. So you're basically not fundraising for most of the year, and then you or most of several years, then you open up the ability to take in as much money as you can. And then you close that whole factory you built to raise the money, you close that factory down, you leave it dormant just to spin it back up again in a year or two. Securities, so products are not sold like that. You're constantly selling products. Securities are exactly sold like that, traditionally speaking. You're raising money from investors, venture capitalists, or angels. You are raising it in rounds. Okay, so that's a fundamental difference. That's why actually my book is called the Evergreen Startup. Because with equity crowdfunding and other tools, you don't need to have rounds anymore. You can constantly raise. And there've been plenty of examples of that more healthy eating approach. Rather than dining at a buffet, you can always have a constantly open round. And plenty of companies on plenty of these platforms, wefunder and Start Engine included, have done evergreen approaches. Start Engine specifically is much more conducive to this for various reasons, but nonetheless, you can act kind of like a publicly facing company, and if something changes in the market and you get some media attention, that drives traffic to your funding round, you can get more money from investors. So you're always raising, and it becomes a revenue stream that goes alongside with your product sales. You're constantly dispersing. It's another problem that wefunder has. That there's much more difficult doing ongoing disbursements with wefunder. But anyway, these are flavors of the platform. But if you choose a platform that lets you do ongoing disbursements, as in you can take money out as often as you want, you can have an evergreen round, as in you can always be publicly listed effectively. And whenever anything happens, you can advertise your securities and you will get attention to that. That's what I call the evergreen approach. But traditionally, it doesn't really work like that with traditional fundraising. Products depreciate. So from a value proposition, when you're selling products, the idea is, let's say you buy an iPhone or something, right? As soon as you bought that iPhone, it loses value. 2 years from the moment you bought it, it's lost more than half of its value. 5 years from the day you bought it, it's lost 90% of its value. So it depreciates, and that's the design of that product. All products are like that. Securities appreciate. So you buy that security, your expectation is that in 6 months it's going to be worth more. In 2 years, it's going to be worth twice as much. In 5 years, it's going to be worth 10 times as much, or whatever your expectation is. But the function of a security is to go up in value. The function of a product is to go down in value. So when we're selling products and we're selling securities, it's very important to understand the motivation of the buyer, because the securities solve a future problem for the buyer. As in, I want to make money 10 years from now when I want to retire and I want to have cash. It's not a problem now. It's a problem I'm going to have 10 years from now. Whereas the product solves a today's problem. I'm buying that iPhone because I want to make some calls or whatever, surf the web. So these are the fundamental difference between products and securities. I'm not going to go into too much, I guess, tactical, just marketing, copywriting, storytelling approaches. But when you are raising, whether it's from traditional investors like VC angels, whatever, or from the crowd, these are important elements to keep in mind when you're drafting the story of your company. Because the motivations, we're all kind of inventors, right? We all kind of live in the product space. That's where we exist. That's where we came to the world in. Whereas the security space, the motivation of the investors is different, and the market is slightly different. So it's just something to keep in mind when you are drafting that story, when you are reaching out to people. To keep in mind that the motivation of the securities buyer is very, very different than the motivation of the products buyer. And the marketplace where you're selling securities is very different than the marketplace where you're selling the products. Anything on this? I know some of these things are a little maybe counterintuitive or not clear. No, good. All right, nice. All right, so I'm going to skip this slide, although I'll distribute it if you guys want. This is the pros and cons of VC versus EC. And there's a bunch of stuff in here. I think probably one of the most important things that if you're considering equity crowdfunding that you should keep in mind is that EC, equity crowdfunding, is not extremely compatible with venture capital. So if your startup is super sexy hot, VC will invest. They don't care what else is going on. They don't care that you have 10,000 people on your cap table. They don't care that your founders are in prison. They don't care that you're getting sued or that you're suing others. If you're super sexy hot, they will invest. That's just how stuff is done. However, if you're not super sexy hot, they're going to take all of these things into consideration. And one of the things they will take into consideration is whether you have gone through equity crowdfunding. Equity crowdfunding is intrinsically a competitive method of fundraising. It has a lot of stigma associated with it, and a lot of traditional venture capital and private equity guys are opposed to it. So if you're one of several options of things that they're considering investing in, and one company that's similar maybe has not gone through EC, whereas you have, it'll be a pretty big ding on your record. Now, I have actually seen this kind of go away in the last year or two, but there's still definitely that friction. The thought leadership that happens in the VC space, so the influencers that they listen to about trends and all that kind of stuff, are generally very opposed to this day to equity crowdfunding. The common consensus really is that equity crowdfunding is ruining startups, and only shitty startups raise money through equity crowdfunding. There's like a backup plan if you couldn't raise money from VC. So if having gone through EC, there's already that burden that you have to overcome when you're pitching for more money. And unless you're super hot, in that case, they'll invest in any scenario. All right, so the other thing I wanted to talk about, and it's a really serious issue for growth companies, for companies that are growing, is that VC can deploy capital much faster, immensely faster. So there have been definitely, Immersed is a great example of people raising crazy fast on equity crowdfunding platforms, but this is definitely the exception to the rule. A lot of campaigns are out there for 6 months or a year trying to scrape to that $1 million, $2 million, $3 million. VC, if there is a market inflection point, if there is something monumental that needs to be capitalized on, and they believe you are the team or company to do it, they can deploy that $5 million, $10 million, $50 million in a heartbeat. They have access to a lot more capital than the crowd has, and they also have more insights into where to get additional capital, and they would argue they have more insights into market trends, and in some cases, they're definitely right. So if there is some market change, if there is some inflection point, if there's some reason that you quickly need money, having gone through a VC round and having a relationship with venture capitalists gets you access to more money much faster than the crowd would. So that's something to keep in mind. That's really important. It's really a big downside of equity crowdfunding.
Since you mentioned Immersed and Renji, can we hand the mic over just for a brief moment to Renji? What are your thoughts on what you've heard so far?
Yeah, I mean, I think all of it is very factual. The only parts that I mean, it's true that a lot of what Michael said, a lot of startups will try to take a perpetual approach to fundraising. It almost comes off as like a stream of revenue. I personally am not a fan of that approach because at the end of the day, yeah, like you said, that some of these startups will scrape by and barely hit the million after like a year's worth of fundraising. But I would personally attribute that towards preparedness and execution. I don't think that it has to be that way. And then also at the same time, when you start getting to the 30 and 50 and $100 million rounds, obviously like crowdfunding is pretty hard to pull that off with. But when it comes to anything, I guess 10 million and below, I think that people have been able to pull that off. It's a matter of execution. So that would be my first kind of gut reaction to what he had mentioned.
I think that's right on. Do you want to actually? I mean, I think this is a good time to talk about your story. It's an amazing story, Alex. If you don't mind, I'd love to hear the story now.
I don't mind.
Yeah.
On the contrary.
Yeah. No, I can share. Yeah. So I mean, we did 2 rounds. We did 1 round in summer of 2020. That was $2 million in 2 days, and then in March 2021. That was 8 million in 17 days. So I think Alex accidentally crossed the numbers, but I appreciate you for giving me more of a explosive perception to the public. But initially the first round, we did crowdfunding. I was actually very reluctant to crowdfunding. There was another app in this space similar to Immersed. I think they're just on PC, and I think it's mainly just solo mode type stuff, similar to virtual desktop, but the product is called vSpatial. They had done a crowdfunding campaign on wefunder, I think fall 2019. I think they raised something like 280K. And I remember talking to the founder at the time, or not the founder, he was the hired CEO, I forgot his name. But I met him at Oculus Connect in one of the kind of the behind the scenes, I guess, sort of meetings that we had. And he was just talking about how it was very difficult to fundraise in the VR space. And I had agreed. I had tried raising just VC. I think at that point we had raised 1.7 million over the course of the previous 2.5 years through angels and VCs, kind of one-off checks here and there. And but we were a team of 8 people, and to fund 8 people for nearly 3 years, 1.7 million is not super easy. And so I guess, yeah, we got to the point where we were kind of on our sort of last limbs as well, and needed to figure out other ways to fundraise, because VR just went through sort of this disillusionment phase between I guess 2017 to 2019. Quite literally when I started Immersed is when it was already on the way down. And as I kind of heard from vSpatial's experience, it kind of gave me a pretty huge turnoff to crowdfunding. So, but then I met the wefunder team, and they also didn't really know what was about to happen with Immersed. They were just like, oh, give it another shot. There doesn't have to be this negative stigma that like crowdfunding is just for companies that have no other ways of funding or no other ways of getting funding. And I was really reluctant, but I guess since COVID had hit around that time, and we started talking with Stephen McDonald and some other people at Facebook at the time, it was really cool to see that people started noticing that our application was giving a lot of users a lot of value, and not just Facebook, but also other users were asking, users were talking about how much they really love the products. We had friends and family who were saying, hey, since COVID hit, our people are searching for ways to collaborate remotely more effectively and things like that. And so we started just getting more interest in general for people wanting to talk about what it looks like to potentially invest in Immersed. But I sent a survey out to all of our users saying, hey, if we did a crowdfunding campaign, would you be interested in investing? And 70% of users said yes. And so that was a strong enough data point for me. Well, sorry, let me rephrase. 70% said they would invest and they would get all of their friends and family to as well. And then 20% said that they would just invest themselves, but they wouldn't tell others about it. And then 10% said no. So 90% of people said they would invest who had been paying, either paying for a subscription for Immersed or using Immersed for free. And we then decided to open up a crowdfunding campaign. But I did do some legwork beforehand. 4 days before the crowdfunding campaign of summer 2020, the first $2 million round, before that had opened, I had actually reached out to what I call my growth squad from that first round, which were people who had expressed wanting to put in 10K, 15K, just random people. And I sent out about 45 texts, and 40 of them said yes. But again, it had to do with the framing or the storytelling, because I was telling them that, hey, we're working with Facebook, where they're QAing our product right now. We're shooting to launch into the Oculus store in August. So we're going to open up a crowdfunding campaign in the beginning of July. So you have a month to get in before we launch the Oculus store, and realize it's a highly volatile investment, but if it doesn't work out, it can work out really well. And so I kind of put the decision-making in their hands, the responsibility in their hands. But also there was a strong sense of FOMO as well. They didn't want to be in a position where they didn't invest in Immersed and it exploded in the Oculus store soon after. And so that market timing was important. That positioning was important. The storytelling and the pitch was very important too. And so because of that approach, 40 of the 45 people I had texted said yes. And these are regular people. These are like a guy who I met who was 28 years old and worked at Google and just had disposable income. This is another person from my church who just thought it was cool what I was working on. So just a bunch of random people. And little did I know, those 40 people, it would be about 300K that would be ready for launch that morning. So we'd start the campaign at 300K, which already beat vSpatial's initial investment round. And so that made me feel more confident about it. And I also told them, hey, the morning of the campaign, I'm going to post a video to social media saying, hey, it's something along the lines of it really just sort of the Immersed pitch and the Immersed story. But I was very strategic about, the first sentence, the first words coming out of my mouth was, of the actual video we blasted all over social media was, hopefully by the time you watch this video, it won't be too late for you to join. And just if you start a video off with that, people are like, wait, what the heck is that? And on top of that, as soon as I launched that video, I told all those 40 growth squad people who invested, 5K, 10K, whatever, to immediately comment on that saying, we're in, thanks for the opportunity. We're in, thanks for the opportunity. And so when you see 40 people write that on a comment and all of their friends see it, it starts compounding like crazy. Then you start getting other people you never even met saying, we're in, thanks for the opportunity. And it just started compounding. And so little did we know, within about, I think 8 hours of us opening up the crowdfunding campaign, it hit about $1.5 million. And then the next day it kind of trickled, another $500,000 came in. We closed that first round. So that was the story of the first round. The second round was very different, but does that make sense? I guess any questions about that? And and a $0 budget. So
exactly,
there was no budget.
But that's my thing. And this is what, when I posted the last mastermind session, you commented the LinkedIn post and the YouTube post saying, hey guys, what Alex is saying is not lean. There's a better way to do it. And now Renji has just revealed the better way to do it, which is, using triggers, virality, growth hacking kind of techniques, psychological techniques. I wonder what would happen if you did the same thing with some extra gasoline in terms of PR budget, performance marketing, etc. But that's a major difference of opinion, or sort of like extension to my idea. I'm thinking about it like I'm calling it industrial strength. Yeah, throw money at the problem kind of thing. As Renji's saying, no, work smarter, not not so financially.
I mean, I guess by virtue of the state of your company, or those who are raising these sized rounds, my assumption would be they're raising because they need money. And so I'd be more conservative on the approach to spending money to start with, right? So meaning, maybe we could have thrown some Facebook ads at it and raised 4 million that first round, but we were only raising at a $10 million valuation. So I didn't want to give away 40% of the company. 20% was a pretty large chunk as it was. And so because we were able to do that with just sort of like 4 days of prep work, and then just 24 hours of me really kind of making sure I'm answering everyone's questions, all that type of stuff. And then the second day, the momentum just carried on its own. And then we kind of closed it. It was sufficient, and I didn't have to spend any money on that. But then the subsequent campaign did require some budget. The next campaign was the $8 million round in 17 days, but our budget was $10K. And we didn't throw it towards Facebook ads because, just like with the first round, we mainly wanted to target high trust people. When I say high trust, I mean specifically people who trust the people who invested in me because they knew me. So it's like maybe the second layer out and the third layer out that didn't personally know me, but they knew other people who did trust me. And like, they also saw the fact that their friends were investing in. And so there was a level of FOMO just from a higher trust network. Little did I know the $8 million round would be a lot harder to raise. And so it was kind of like in 4 waves, the start of the campaign, the end of the first week, the start of the second week, the end of the second week, and then we kind of closed it from there. But it kind of happened in 4 waves. And but the high level abstract concept of starting with people who know you better, who trust in you more, who love the product, start with them, and then from there reach out to their networks who believe in them. And from there, over the course of time, you start marketing to people who are less and less high trust, but instead are more susceptible to FOMO or need more social proof first. And so for people who don't need as much social proof, those are just the people who know you. They trust you that you're going to do a good job with their money and all of that. You can start with them because they don't need social proof, and they were the ones who would essentially invest more money in your company to start with, and that would accumulate over the course of time, so that can then be a data point for those who do need more social proof, who need to see, Immersed raised $3 million within the first 24 hours. Okay, there's $3 million worth of money that wants to be Immersed within 24 hours. Okay, maybe now I'm willing to throw in my 20K, 50K, whatever. And so for that round, now my growth squad wasn't just the initial 40 from the previous round, but instead it was the 700 of that previous round. So that was what enabled me to kind of get the 3 million within the first day. And then by the end of that first week, it hit about 4.5 million. But then we kind of had to do another kind of supercharge approach, which I'll talk about in a second, kind of another PR push. Then through that weekend, the beginning of the second week, it hit about 5.5 million. And then by the end of that week, it hit 8.1, and then we closed it. And so when we first launched the second crowdfunding campaign, I used those 700 investors from the previous round to be my growth squad. So I email blasted all of them saying, hey, we do want to give you guys an opportunity to invest before the round opens. So throw in whatever money you can. I think that maybe hit probably 800K before the round even opened. And so, because people just wanted to re-up, seeing the progress. And again, at the end of the day, you still need to build your company. So between summer 2020 to March 2021, Immersed did launch into Oculus Store. We did get our daily active user count up. We did get our revenue up. By God's grace, I did hit Forbes 30 under 30. And then HTC and Microsoft also did reach out saying they wanted us to start working on a version of Immersed for their stores as well. And so that we did have to have traction, but taking all that traction and then pitching it to the 700 people who already invested in you. Now you have people who are like, whoa, I should have put in way more last time. I had no idea you guys would do that well. And so, they're re-upping for this next round. And then they're also getting all of their friends and family. So that's why Immersed was able to close on 3 million just in the first day. And then from there, that kind of trickled down and slowed down to about 4.5 million by the end of the week. And at that point, we had a couple of different social media influencers who I knew, like, it was like a friend of a friend. It wasn't really a person who I knew. It's just most people are a degree or two away from pretty influential people. And so I sent them a headset and said, hey, if I send a headset, will you make a post about Immersed? And as they found out about what Immersed was, the influencer themselves wanted to invest. And so they invested, and then they're now telling their entire network, oh, look, guys, I just invested in this thing. You guys should all check it out. And so we just had another influx of a couple more $1 million coming in. And then, once we hit kind of about 5.5 million by the end of that first weekend, and the start of the second week, I started noticing it slowing down again. I had then looked through the people who had invested, and I reached out to some of the higher net worth VCs in that round. So we had 7 VC firms in the round, just passively. I didn't pitch them or anything, but I thought maybe I should, double click on some of these VC firms to talk with them, see if I can up their amounts, or just kind of see if they have a network they can tap into as well. So I reached out to a guy named Cody Willard who had invested in our company. He used to be a news anchor on like CNBC and other things. He now has a website called tradingwithcody.com. But as we found out that he had actually written an article about Immersed, and broadly, specifically about like work in VR, but then Immersed was the startup that he had highlighted. He actually wrote an article about us 2 months prior. And when I saw his name, it kind of clicked. I was like, wait, that name sounds familiar. I Googled him and I found that he had written an article about us. So I was like, all right, let me reach out. So I reached out to him, talked with him on the phone for about 30 minutes. And at the end of that phone call, he upped his 50K investment to 150K. And then he blasted his Trading with Cody network. And what was so crazy was when he had blasted them, for the next 24 hours, we just started seeing, random 50K checks saying, Cody sent me another 100K, Cody sent me another 50K, Cody sent me. And within about 24 hours, it hit another $2 million. And that's where he hit 8.1 million and we closed the round. So part of it was having to be very scrappy and resourceful given the cards that I had at hand. But it's so important to make sure that you can ultimately leverage what is in front of you to the best of your ability. Oh, and one other thing I forgot to mention was part of the 10K budget was not just us sending VR headsets to influencers, but also us doing one giveaway where we were ultimately broadcasting Immersed crowdfunding campaign to just the broad general network all over Instagram. And so the people who had invested, I had said, hey, like for all of you who had invested, if you tag your friends in this post, share this wefunder link with all of them, we'll enter you in for a chance to win a $3,000 Airbnb gift card with a MacBook Pro and an Oculus Quest 2. So you could ultimately become a user of Immersed and on top of that, have an awesome vacation or something. And then that post grew to like 10,000 views within just a couple of hours. And so giveaways are a very powerful tool on Instagram, as long as it's a relevant thing. And if people can trust you, that they don't think you're some sort of scam or gimmick. So that also kind of was the end of the first week and into the second week. And so all that to say, like, we just took the cards that were in front of us and we just leveraged it. And so we took what we had from the previous round, because that was now another tool in our tool belt, and we used it for the next round. Now we're using this round for an additional round that Immersed will be doing. We're not necessarily going to continue doing crowdfunding campaigns necessarily. We may do one in the future, but a lot of that traction has gotten us to where we are today currently, and Immersed is going to be doing more fundraising in the future. So I certainly anticipate us using our current network to then raise future rounds.
Well, thank you so much for revealing the blueprint, opening the kimono. Back to you, Michael. What are your thoughts on what Renji said? And sorry to interrupt the flow there, but that was well worth it.
Oh, for sure. No, that was amazing. Renji, I actually have a question. Did you do any PR, like media outreach or anything like that?
All of that was passive. So meaning we just found out that people were writing articles on us. We didn't necessarily pursue anything. And oh yeah, one thing I forgot to talk about as well. So I mean, just Immersed is getting a lot of inbound from a lot of larger VCs whose names you've probably heard of. And we are looking to, at some point in the future, close on a round. So the fact that we did do crowdfunding actually was not a deal breaker for them. And that's probably, it might be under the category you mentioned, oh, like sexy startup. Okay, well, of course you can fundraise whatever. But that being said, just in the grand scheme of things, Immersed is still not a unicorn company. So we haven't proven out ubiquity even in the Oculus ecosystem. So there's still definitely some risk and concern with that. However, what I will say is I think one thing that wefunder really did a good job of was making sure that all of the investors from our previous rounds are just one line item on our cap table through an SPV. So that just made it a lot easier, a lot cleaner for future venture capital firms to want to invest 10 to 50 million, et cetera, in subsequent rounds.
Yeah, that's a great point about the single line item. So companies have been doing that. So that's a regulation that actually just came in to effect about a year ago under the Biden administration. There was a series of reforms. One of them pushing up the maximum to $5 million a year in RegCF, and another one is having that SPV mechanism. Startups have been doing that through what are called IRA custodians for a number of years beforehand, but yeah, if you guys do choose a platform to do it, you should make sure that they support the SPVs, like Renji was saying. It's a huge deal to investors. Yeah, I thought awesome story. That's a great story. I never knew what the back end of that campaign was, and it's magical. Congratulations. All right, so let's move on a little bit. It's just an overview of the largest platforms. So the idea is, this is going to be all super boring after Renji's talk, so I don't even know if I should keep talking about this stuff.
That's what I was thinking. Hard act to follow, like.
Yeah, I don't know, man. I think give up, go away, but anyway. And by the way,
one funny thing about this slide, all the platforms are telling, I'm in touch with all of the platforms. They're all saying how much better their platform is than everyone else's. So this is a good slide here.
Yeah, they all have like these vanity metrics that they use to say that they're the biggest platform, and it just made up shit. But yeah, they're all the biggest platform. Everybody you'll talk to will say they're the biggest platform. Renji, I got another question for you, actually. So you went to Techstars, right? I see you got the hoodie.
Yeah.
What did they think about your equity crowdfunding?
Yeah, they were not supporters in the beginning, but then once we pulled it off, they're like, oh crap, you have way more control of your company now, so never mind. So they definitely did have a stigma, and I did have to break a lot of kind of, what was funny was even our managing director from Techstars, it was funny because he was just like, it's so insane because they taught us a very specific way in which, like, they have a lecture around, I think it's, what's the guy who, David something, who like is one of the founders of Techstars. He does, I don't know, I'm blinking. Yeah, so.
In 2014, I took a company to Techstars.
Oh, nice. Yeah. So David, one of the founders of Techstars, he does a talk where he talks about how do you actually collect soft commitments from VCs and how do you kind of get all of them, how do you herd cats and get them all to ultimately wire you money. And it was funny because in order to do this crowdfunding campaign, I just had to throw all of that out and like take my own approach. And it was funny because it did work out well from the standpoint of we did get to pick our valuation. Obviously, it has to be reasonable because at the end of the day, if it's too high, the market's not going to respond well to it. But so I'm responsible for my valuation. And at the same time, I have to make sure that I give people confidence that we're not going to just take the money and run or something, right? So it's funny because the Techstars network in general, they were just kind of sitting back and watching. And now, we kind of broke whatever stigma that they had of crowdfunding, because now they can point to us and say, oh, look, well, Renji and Immersed did it, so go talk to him if you want to take another approach. So I really appreciate the fact that, like, even wefunder, for example, they're trying to change some of the stigma away from calling it crowdfunding, because it almost has a historical stigma of, okay, well, if you can't get VC money, then this is kind of a last resort. You're kind of a company that is probably going to die.
I'm hearing the word community round.
Yeah, that's the phrase that they're going for. So I like that phrase. Like it's a seed round, there'll be like a community round, like users, followers, friends, family. And then from there, you kind of graduate to maybe an angel round or go straight to VC. I think both are awesome. So
that's kick-ass. Yeah, so I want to say about 4 years ago, Techstars Boston had a pilot program with a platform called Net Capital, which is another Boston platform. And so at the time, this kind of has faded away a little bit, but there is a secondary marketplace for securities that you buy through equity crowdfunding. So basically, it's one of the advantages, just for everybody here who might not know, one of the advantages of investing through RegCF, or specifically this mechanism, is there is the ability to sell the stock that you buy on a marketplace. So you have liquidity. You don't need for the company to exit or to fail or to go IPO or whatever. You don't need for that events to happen in order for you to get some money back for your stock, for the stock that you buy. So Techstars, I know, was going through, they had a pilot where every company that was entering Techstars in Boston would go through a RegCF campaign, and Techstars would invest through that campaign so that they have that exit option. It didn't materialize. They had some interpersonal issues with the platform, and I completely see what happened there. But yeah, and then the marketplaces, the secondary marketplaces kind of went away. There's still some focus on it, but it never really materialized, and there's a lot of structural issues for that. But it's really great to see that Techstars, in general, is starting to come around. They're still super siloed from what I hear. I still have a lot of connections. They don't like to play, they don't like to share their sandbox with other methods, with other organizations. They're very, very isolated. So, but it's really good that they're making some attempt to grow and evolve, and that's great. That's great to hear.
Yeah, they can't argue with the data. That's really what it comes down to. Yeah.
And I'm happy that they stopped pretending they can, I guess, or stopping. But anyway, that's great. So so anyway, back to this slide a little bit. So the way that the industry works, part of these reforms from 2008. The start in 2008 is one of the ways that they're reducing fraud in the market. So the problem with having a private company sell securities is that the private company can lie, and it's snake oil, and they can steal people's money. So one of the controls that FINRA, the Financial Industry Regulatory Authority, which is a US government entity, and other countries have equivalencies, and the SEC, the Securities and Exchange Commission, they came up with a set of rules. So some of these rules are the burden of the startup, like having an audit done, having some financial disclosures, other things like that. But some of these things become the burden of the platform. So the platform also needs to go through a level of diligence. The platform needs to provide a place where people can ask questions to the founders, and then the founders' answers are publicly available to every investor. And there's a bunch of things like that. So part of the burden of that disclosure, of that honesty, falls on the platform. Part of the burden of that disclosure and honesty falls on the startup. To reduce fraud. So basically what this comes down to is that FINRA needs to approve these platforms after they've showed that they can take on the burden that the government put on them to be, fair and to disclose information accurately. So you have to go through an approval process. I think there's it's a little slightly out there. There's probably 180, 190 platforms now that have gone through the process. A lot of them have been extremely specialized in things like real estate, or biotech, or really, really niche things that they've been able to get investors in and build up a startup community. A lot of them are generalists, as in they'll take pretty much any startup.
There's no Metaverse specialized platform yet.
So I would not be surprised if there was one already in the works, or it's coming out, and somebody like Facebook would be a good example of somebody who's capable, and I know they're looking into this space to expand. So for what it's worth, that's what I hear. I don't know how accurate it is. You guys probably have more context there than I do, but I do hear the buzz that they might be entering into a space adjacent to this. But anyway, so the largest platforms that exist right now are on the slide. This is platformed by dollars invested. Again, everybody will have their own version of this. Some platforms say we're the largest because we have the most investors, although those investors are not necessarily active at all, or maybe they made one investment. By the way, about 60% of investors on these platforms only invest once. And they're still reported as active investors, but the company brings them in. Almost all of about 80% on average of the investors that will invest don't come from the platform, they come from your efforts. So let's say the platform has 1 million people that are investors on the platform. Honestly, you would be super lucky if 20% of them showed an investment in your company, because almost everybody you bring in comes from your own efforts, from your own viral efforts, like Renji's, from media, from Facebook ads. Facebook ads, by the way, are the default method for people who want to spend money, who can spend money to advertise this offering. So pretty much every campaign that has had to scrape $2 million bucks, not a magical story like Renji's, which was awesome, had to buy Facebook ads. And that's another element of Renji's story, which I think is amazing, that it's completely organic. It just shows how amazing and sticky their product is and how good they are at community things, which is a crazy rare thing to see in the industry. But yeah, so basically the way you would do it, but these platforms, the 3 largest platforms, also now have internal marketing teams that you can hire to promote this. Republic recently bought a company called the Aurora Project based in Miami that used to be wefunder's internal marketing team. There was in a separate company, there was some investment mix-up. I don't know if you guys follow the gossip stuff. Anyway, there was a big fuck-up. They left, Republic acquired them. It's like an acqui-hire, they took them over. And now they're doing Republic's internal marketing. So basically when you join Republic, you can pay them more money and they'll do Facebook ads for you. When you join Start Engine has a property called Start Engine Promote. You pay them money and they'll run Facebook ads for you. They have their own audiences, which are investors and things like that. So they're experts in it. So a lot of these companies do. wefunder right now doesn't have that mature of an asset, as far as I understand, but I'm assuming that they're working on it, and I have some contacts there that I've been meaning to follow up with on a related topic. So if you don't have experience in running Facebook ads or doing these campaigns, then you can hire the platform, or the platform will definitely have referrals for you as well. So this is not a capacity that you necessarily need to have. In fact, when I've tried to build out a company's capacity to sell securities on Facebook, it was always super tough. So selling products and stuff like that, from my experience, has been easier than building up their audiences to sell securities. So it's pretty decent to go with the platform and the platform's audience. The platform's efforts. Some platforms don't do that at all. So like, for example, Seed Invest, which is kind of a niche platform, they don't like Facebook at all. So what they do is almost entirely outreach to their current network of investors, and they'll actually do all the marketing for you. They don't want you to really do any marketing on your own. But anyway, every platform is super different. That's the reason I bring it up, because the regulatory part of it, the thing that FINRA approves, is kind of like the trustworthiness of that they have to make sure that the company is trustworthy. As far as the operating model or the business model, pretty much every platform has their own flavor. And that's something important to keep in mind, because even if the platform is smaller in size, maybe it has a better flavor for what you're looking to accomplish. But the 3 largest platforms, like I said, are Republic, which is the newest of the 3, wefunder, and Start Engine. And wefunder and Start Engine have been at this for a very long time. Any questions on this general overview? All right. So how much time do we have? I don't even know if I have time to get into this slide. All right. I mean, I don't know if we have time, but I'll talk about different types of ways to raise money. So this moves a little bit outside of what we've been talking about, equity crowdfunding. It'll move back into it, and then following slides we'll probably never get to them. So there are 4 different types of securities for the purposes of this framework. You have the traditional securities. These are things: stocks, bonds, option, warrants. They've been they're defined as such in the Securities Acts in the 1930s in the U.S. So they're very tightly defined. They're very tightly regulated. You need accredited investors. You need to sign up for a RegCF platform. So that's the stuff here in green. An extended security is basically the same thing. You're selling the future.
Thanks,
of the
Renji. Renji's dropping off. Thanks a lot, bro.
An extended security is basically it's still selling the future value of the company, but it's not a regulated financial mechanism. The top example of an extended security is a loan. A loan is not regulated at all. You can take a loan from your grandma. You can put up a Facebook ad saying, I want a loan, and it's not regulated by the SEC. The SEC doesn't care. It's not considered stocks, bonds, options, or warrants. And it's a very common way to take in money as an alternative way. So there are crowdfunding platforms that pull people together to give loans. One of the most common ways in the speculative investor world, like the startup fundraising world, to take loans is to give what they call a revenue derivative. So let's say you're talking to an investor maybe is on the fence about buying your stocks from you. You can offer him the deal. Listen, you give me 100 grand. I'm going to give you 2% of my revenue until you get 200 grand back. right? This way, there's always that liquidity, there's always that cash flow going back to the investor, and it might not be a significant revenue burden for you, but you have to do the math on your own.
I have a question.
Yeah, of course.
Why are loans so much less regulated than securities?
This actually went to the Supreme Court in 1997 in the United States, and it's a complicated thing, but basically because they don't transfer into ownership of the company. So anything that represents ownership, they've decided would be a security. Things that represent control but not ownership are not securities. So grants are another example. You take $100,000 grant, you have to do the stuff that that grant says, or you might go to prison. Right, so it gives the grant issuer control over what your company does, but it's not a security, you know. So yeah, it's not dilutive. You don't lose ownership. They don't own any. You don't lose less. You don't have less ownership of the company if you take a grant or you take a loan. But the people who gave you that note, the people who gave you the loan or gave you that grant, do have a significant amount of control. So that's kind of where the Supreme Court settled on this issue. If you get control but not ownership, it's different. Where in securities, you don't really get control a lot of the time. You get ownership, but you might not get control. Like if you buy a share of Apple, you don't really have any control over Apple. You have zero control. So anyway, so there's a lot of examples of extended securities. I go into those in the following slides. Now, it's important to realize that out of the hundreds of types of extended securities, and to get money into your company without selling ownership in your company, a lot of those are supported with various forms of crowdfunding, from nonprofit crowdfunding to loan crowdfunding, also called peer-to-peer lending. Maybe you've heard these terms. So there are very, very popular alternative ways to get funding, to get money into the company without giving up ownership of the company. Anyway, that's what I call an extended security, and there's, you know, it's supported through crowdfunding and supported through direct efforts as well. Moving through this list, and these are the types of securities which I'm not going to spend too much time on, but things like proxy securities. There's actually a significant amount of these. They're used actually in what the meta space used to be called, the crypto space, I guess, the not physical reality space. The most popular example of a proxy securities are ICOs. If you guys remember initial coin offerings, from a few years ago, they would issue coins. They still do it to a degree. It's just the industry has matured a lot. And through this mechanism, they would issue utility tokens, which would represent ownership and control over the company, but they were designed to circumvent traditional securities. Companies raised tons of cash through these mechanisms. Turns out the SEC was not a big fan. Now there's a bunch of lawsuits. Right now, it's all slaps on the wrist. I haven't seen anybody go to prison, but the SEC does really hate this stuff. Anyway, that's a proxy security. So it's something that's designed to mimic a traditional security, but circumvent all of the regulations of a traditional security. Some of these equity crowdfunding platforms that I mentioned earlier actually started in this space. They moved away from that space, but they started in what they call tokenizing. And I'm sure that's a term that you've heard before. It's tokenizing securities. So making securities into basically tokens or coins, whatever you want to call it. One of the biggest players in the space early on was Start Engine, one of those three platforms. Anyway, but they've left the space because the space is not conducive to what they want to do. By the way, most issuances now, almost all issuances in the United States do coin offerings, do go through the RegCF mechanism, the same way that you would raise money for your startup. So they're doing it in a regulated and controlled way. Yeah.
Can I pause you for a sec, Michael? I just saw Sam Wong joined. Are you with us, Sam?
Yes, I am.
Yes, hello. Nice to have you here. He just jumped off his other call. Sam Wong is the founder of Fundable Startups, which is an e-learning platform for helping companies do fundraising the right way, not make the kind of basic mistakes that many founders do because it's the first time they're doing it. So good to have you on board. We've just had a really good session of Michael talking through his lecture on equity crowdfunding, early stage finance. Renji Bijoy from Immersed told his story, his major success story, and yeah, good to have you on board.
Hey, Sam.
Back to you, Michael. Sorry.
Yeah. So anyway, then the other type of security, which is kind of a combination of securities, and it's probably the most common, overall is what I would call a hybrid security. We'll cover this. This is basically you buy stock, but you also get some other control during the investment process. The easiest way to think about this is if you guys have seen Shark Tank, you have like somebody like Kevin earlier was saying, I'll buy 2% of your company and 2% of your revenues. Okay, so this is a way of combining a traditional security and what we talked about an extended security being a loan in that case. So when he's buying a 2% of your revenues, he's buying an extended security mechanism. So it's a combination of a traditional and a hybrid security. It's very common, mostly common, almost entirely with traditional investors. You very rarely see this in the equity crowdfunding world, but traditional investors will almost always have some level of control over your company, especially the later stage that your rounds get. So they might get a board seat that needs to vote on certain things. They might need to, for you guys, to approve you issuing options or if you're taking on debt or anything like that. So those things that they get kind of on the side of the investment, it can be structured as what they would call a side letter, or it can be structured on the investment itself. But the stuff outside of the stock they get, or the special provisions built into the stock, are valuable things to them, obviously. So it's something you sell and it should be priced into the deal. Anyway, that would be an example of a hybrid security. It's just a combination of different types of security mechanisms in one, and that's by far the most common way to raise traditional funding, by selling a combination of control and a combination of ownership to your investors. Any question on this slide before I move on? No? All right. Yeah, I'm going to skip this. Because there's a bit of overlap between what we discussed earlier when we were talking about the difference between products and securities. But these are the differences between extended and traditional securities, but for the purposes of time, I'm going to skip this. I will note one thing. The regulatory authority that regulates traditional securities is the SEC in the United States. The SEC, the Securities Exchange Commission, and FINRA, the Financial Industry Regulatory Agency, who regulates not traditional securities, so grants, loans, any of those other mechanisms, is the FTC, the Federal Trade Commission. So basically, these are the truth in advertising guys, right? So if you lie about your use of funds, if you lie about your financial whatever, these are the guys that might come after you. Now, it's a really gray line here. They're not nearly as well funded. The SEC is there's hundreds of lawyers. The FTC is a whole bunch of different folks, and they tend to go up after larger companies for big misleading statements. So like, for example, you've seen a Budweiser commercial, right? So somebody might drink a Budweiser and then overnight, as soon as you drink the Budweiser, 20 girls in bikinis show up at your pool party, right? So they would go after, in theory, Budweiser for saying it's not true. You don't drink Budweiser and get girls in bikinis at your pool party immediately. And that's a real example of something they did go against. But that's the kind of stuff that they're kind of chartered to do. In the crowdfunding world, I have not seen a single example of the FTC going after, equity crowdfunding is not governed by them, but I haven't seen an example of them going after peer-to-peer lending or loan crowdfunding. But I have seen plenty of examples of them going after like GoFundMes, which are nonprofit crowdfundings, which is charities. And most recently, they also tend to go after Kickstarter campaigns. One of the largest example is a Kickstarter campaign called iBackpack, which did everything they were supposed to do on the campaign, but they didn't use funds the right way. So they raised, I don't know, 700, 800, whatever it was, and they stole it. They bought cars and houses and whatever. They spent it on themselves, and they didn't use funds the right way. The FTC are the ones who got after them, and the FTC are the ones that they had to settle with. So the reason I bring it up is because when you're selling traditional securities, you might get approached by the SEC, which is much more capable and much more active in patrolling this space. And they're very weary to this day of equity crowdfunding. There's still a lot of stuff that they're not allowing that is being in proposals for equity crowdfunding to do. So keep in mind that if you do equity crowdfunding, the regulatory authority there is significant, prevalent, and they're keeping an eye on things like your annual reports and all that kind of stuff that you have to do. It's less so with extended securities, but you still don't want to lie when you're applying for that grant, because there are agencies that will go after you and you won't be happy when they do. Okay, so I'm going to skip the rest of the slide, all right? But I just wanted to bring up those 2 points about lying. even inadvertent lying. You shouldn't do it in either agents, in either type of fundraising that we're going to be talking about. Any questions here? I'm gonna, you know what, before we move on, because we're kind of running out of time and the next few slides are getting super in depth about different mechanisms stuff. Though I want to add another kind of note, well, because it's kind of on the periphery of this topic, on the topic of lying. One common way that companies lie is accidental. They don't mean to. So this is actually a really big deal because people have been dinged for this. If you raise money from angel investors or venture capitalists, those guys love to give you a call on the weekend and ask, hey, how was your revenue last month? You know, do you have any, big contracts underway? Do you have any customers in your pipeline? And this is a very common conversation to have with an investor, with a private placement guy like a VC or an angel. These conversations are not legally allowed to happen with equity crowdfunding. For one thing, everything you release that's important, that can cause market condition, market disruption, market notice, needs to be released to everybody at the same time. Okay, this is just one of the anti-fraud provisions in equity crowdfunding. So basically, you can't, when your VC calls you, so if you take VC money and equity crowdfunding money in the same company, you can't tell that VC guy some proprietary information. You can't, which will create a lot of friction with the VC. But because they need this, right? This is their model. They want to be able to call the founder, develop that relationship, and find out what's going on financially or whatever, in any kind of material way with the company. And they're used to it, and that's just how the model works. And you as a founder spend a lot of time managing that kind of relationship. Now with EC, if you have gone through EC, you're not legally supposed to share this information with them. Now, you couldn't actually share this information with a crowd either. And the reason is because if you're going to release financial stuff, it should be audited before you release it, because you might just be wrong. You might accidentally report an incorrect number that would not be the same number that you would get after you go through an audit. And that's a completely innocent mistake. And you might be doing everything the right way, but you will need to submit that audit at the end of the year, potentially with EC, depending on various things. And if that number that you submit after you do that annual audit is different than the number that you submit earlier, you report an incorrect number to investors. I have not seen any legal issues directly from this, but I have seen people get letters from the SEC pinging them for having annual reports that are not congruent with the numbers that they might have released. So that public disclosure, it's critical on when you're taking money from venture capitalists. It's again, this is not an extended security thing. An extended security thing, you can do your kind of best. You don't really need to go through audits because there's no EC component to it. There's other types of crowdfunding, like I said, like GoFundMe's and Kickstarters and all that extended securities, but they don't have that public disclosure regulation to it. But if you do go through EC, you're much more limited to how you can communicate with your VC and angel investors. And it's actually really problematic, and it causes a lot of friction. So my company, my latest company, we've taken money from VC and from the crowd, and this has created friction because VCs don't understand why you can't just tell them these things. They think you're avoiding them, or you think whatever. There's all these different things. And as far as objections that VC have to equity crowdfunding, this is one of them, because part of their model is to be able to get these numbers on a regular basis. And as a startup, you can't do an audit every quarter. You do an audit once a year if you can afford it. So you can't give them numbers every quarter, realistically. I mean, what happens in practice, you have interpersonal conversations and whatever, but it's a thing you need to consider. So if you're mixing the two paradigms of fundraising, VC, EC, then it's something that kind of information rights aspect of it does need to be addressed, because those guys that had maybe unofficially agreed to information rights, like your venture capitalists, they don't have them anymore. And that can create a lot of friction. Anyway, I'm going to leave it at this just because we're running out of time.
We have gone over time. For the people who've stayed, they must be engaged. They must be enjoying what you're saying. It's pretty intense. Let's wrap it up. In conclusion, Michael, for the crew who's here, let's assume that they're all into VR and are interested in fundraising for their entities. what would be your sort of playbook in conclusion of what path everyone should pursue?
Yeah, so I think like we talked about before, it depends on the demographic that you're in. If you're a female founder, if you're a Black or Latino founder, maybe your path will be a little different, just statistically speaking. Right now, meta stuff, the Marvel Cinematic Universe of crypto assets, just how I think about meta. Anything that can be positioned to be part of the meta universe, the metaverse, it does have investor appeal to it. So you're obviously all part of that genre, and that genre right now does have investor interest, traditional investor interest. That being said, it also has consumer interest. So I think there's the space that you guys are in is a particularly attractive space right now for either type of crowdfunding. But if you have, let's say, a B2B application, an enterprise application, you're probably more likely to raise at better terms from VCs than from the crowd. If you have a big budget to spend on ads and you have a big community already, you might get a much better deal from the crowd than you would from VCs. But it really depends. If you have a lot of IP, a lot of trade secret stuff, and a kind of a rock star team of PhDs doing stuff, you're probably better with VCs. If you have influencers and people with huge TikTok followings, you're probably better with the crowd. So so it's not a direct answer, but it's something that there's a lot of variables. And I think the takeaway is that the crowd, equity crowdfunding crowd, should be a tool in your toolbox. So when you are evaluating how to raise money, that should be one of the things you think about when you're doing it. It's not right for everyone, but there are definitely conditions where it is right. And as we heard from Immersed, amazing success stories do exist specifically in this space that we're talking about.
Even before the hype picked up last year.
Even before the hype, and now you
Guys,
see a lot of stuff coming in.
Any questions for Michael? Anyone want to bring anything up before we close up? Thank you for being good listeners. Okay, I'll be sharing.
I had a quick one, Alex, real quick.
Ahead.
When you say, like you have a big marketing budget to, go out and do your own kind of ads for a crowdfunding, like what's your definition of what a big budget looks like?
Well, so I'll answer that. I mean, there's no definition. I mean, for some companies, a big budget is 10 grand. For some companies, a big budget is 10 million. Look, if you can pay Kim Kardashian 500 grand to Insta about your campaign, you're going to raise a bunch of investment.
I'll give you another way to
Never
look
going to
at
happen on our side. Thanks.
it.
For both the choice of influencer and the money.
If you spend 10K and you're not making money back, if you're not making money on that spend, you close it up. If it's making money, you keep it open. So that it's how long is a piece of string. You're watching the ROI, the return on ad spend. That's how.
That's always the problem with ads, though. In general, though, a lot of times because you're testing the market in different areas, and I'm really intrigued by the fact that that's a big differentiator with wefunder versus the other ones. Is that wefunder does not have that marketing arm, and people like us, I don't know where to go tap into those Facebook pulls. I'd be guessing when I build those marketing campaigns without hiring yet another person to do that. So that's kind of really interesting.
You would hire an agency, it would cost you money. With the platforms that do have internal marketing teams, you're still paying those marketing teams separately. So there's still a budget to be associated with it. But
it's a must spend. You have to hire that agency because they have the retargeting audiences. And so you're not getting cold traffic. You're getting people who've already invested in things before and lookalikes and that kind of thing. So that's a cool part of the business plan.
The ROAS being the Facebook term for return on investment spend, and you want to target as 4x. So you spend $1, you want to get $4 in investment. And the strategy is going to be around that. And it's relatively conservative number. There are people who get 500 ROAS, 500x ROAS, and there's people that struggle to get 1x. But the industry target of the mark of a successful campaign is you get that 4x. And you work out a way to get what are called rolling disbursements from the platform. Not all platforms support this, and the ones that don't, you need to have personal conversations with them, and it's still a thing. And it should stop being a thing, but it's still a thing for a lot of these platforms. Rolling disbursements, as in every 2 weeks, every month, you can take the money out that your campaign has raised. You'd be surprised how many platforms need you to finish that campaign, as it would be like a year without having access to the money that you see on the screen. So you want that rolling.
That's a killer tip right there. Yeah.
Yeah, exactly. And this is a conversation. Even the platforms that don't publicly support it, you can still talk to them, and sometimes if they like you enough, they'll give you that ability.
Cool.
Now, on that end, if you take that money out, you should be reinvesting a portion of it into more spend. And again, if you, let's say you get that 4x, you take that money out, invest it, and you get more spend, and it's kind of an on-rolling thing. And you can get to 4 million that way. You can definitely get to 5.
Okay,
Nice,
everyone.
thank you.
Any other questions? Ladies and gentlemen, thank you. Thank you for your attention. Thanks for staying on over 1.5 hours, just about. We will continue on the next episode. Maybe we will invite Sam to present his material. It's friggin' awesome. Check his stuff out on YouTube. Sam, you're a bit new to the equity crowdfunding space, am I right?
I've actually had one startup go through an equity crowdfund, and they underinvested in the marketing. The other side of it was that that particular startup did not get good service from the crowdfunding platform. Okay, I can talk about that was my first and only experience helping a startup go through that. I have different perspectives. I think equity crowdfunding is a very viable option now. It used to be frowned upon, but it's very viable today. But I'm sure Mike's the expert here. I'm sorry I missed the beginning part of it, but I'm sure
you got to hear Renji's story. We'll send you the video. It's a bit of a miracle, and we're going to all try to replicate that kind of outcome. But thanks to everyone. It's 11 p.m. here. I'm signing out. Until the next episode.
Bye, guys.
Thanks, Michael.
Anytime. Bye, guys.
Thanks, Michael. Thanks, Alex.
Bye, guys.